This is New Home Insights, the John Burns Real Estate Consulting Podcast. I'll be your host, Dean Worley. As the title promises, we're going to bring you insights into everything housing, latest trends, innovations, observations, and issues of the day. We'll bring in colleagues here at John Burns and also some major industry players from all across the country. This podcast is going to be quick, fun, but also hopefully make you think. So see you here every couple of weeks. Now let's get to it. Hey, welcome to New Home Insights Podcast by John Burns Real Estate Consulting. I'm your host, Dean Worley. Today, we have a I'm going to use the word august guest with us today. He's laughing. That's Doug Duncan. He's a senior vice president and the chief economist at Fannie Mae. That's the government-sponsored enterprise that possibly has a whole lot to do with your mortgage. Doug, why don't you give yourself say hi and introduce yourself, please.
Yeah, hello. Good to be with you. Thanks for the invite. It's always, the key for an economist is getting invited back. I run a group called the Economic and Strategic Research Group at Fannie. So we do forecasting, but we also operate at the enterprise level, and we're responsible for things like thought leadership and working across the company to some degree as an internal consultant, helping with business problems across the place. So we have about 35 staff or 40 staff, something like that in the group. It's a little bit unusual for a chief economist role, but it's fun.
Yeah, that does sound a little more expansive than you'd think from the title, doesn't it?
Yeah. We have a long-term research group. We have a market research group. We have a forecast group. We have a multifamily forecast group. And we have a surveys group, so we do lots of surveys both within and outside the company. Pull all those things together. There are synergies between them all, and help the company understand the current and expected context in which we will do business.
Okay. So, today what we're going to focus on is quite a bit of mortgage rates, really, but on the FHA and just how Fannie Mae impacts the housing market. And, and looking ahead with a little bit of crystal ball into the near future. So let's start with a biggie. One I think that is frequently misunderstood. And this is that is mortgage credit loosening right now, or is it tightening right now? And I'm going to ask you to maybe separate that out by the three main types of mortgage, which is FHA, GSE, and jumbo type loans.
Sure. We actually measure that in a couple of ways. We survey consumers to get their point of view on whether they see credit conditioning easing or tightening. And then to see if there's a mismatch between consumers and lenders, we also survey lenders and ask them. And of course, part of what they answer will be based on what we do with our credit criteria. And then we get a pretty good look at the total picture of mortgage originations through some triangulation aspects of data. So the bottom line is that underwriting criteria today are fairly stable. Starting at the end of the crisis, there was a severe tightening of credit standards because of the crisis. Then there was a long period of gradual easing of credit standards as people, including us, were working to see where's the right balance between risk and return, not just from the lender perspective or our perspective, but also from the consumer's perspective. Because one of the risks is if you ease credit conditions too much, you're putting particularly low and moderate income households into a highly leveraged asset, which is subject to market swings, and you could be putting them at risk. So for the last year or so, the underwriting criteria have been pretty stable after a significant period of easing. The place that they're at, if you were to compare it historically, it's probably back to somewhere around where it was in the late 90s.
Okay, I was actually going to ask you exactly that. So from a long-term perspective, where something like the late 90s, which seems like it was a fairly, quote unquote, normal time.
Yeah, the market, housing worked pretty well. People were able to get credit subprime wasn't an issue back then. And those loans performed very well. The households were very stable, low delinquency and foreclosure. With the difference between the different groups of securitizers or investors, FHA has actually been tightening some conditions because there was some concern about people churning the portfolio for small interest rate increments where households had to pay significant fees, and it wasn't clear they were really getting value from those refinances. So FHA tightened some criteria to reduce that refi component. The GSEs have been, as I said, pretty stable, and both the consumers are reflecting that and lenders are reflecting that in our survey data. The bank portfolios and other whole loan holders, there's been some experimentation at the margin in the subprime space. The jumbo space has actually been quite healthy, but that has slowed significantly, partly in response to the changes in the tax code and partly due to the rise of interest rates, with those households having pre-positioned themselves for changes in rates. So a little bit of experimentation, but it's a very small share of the market, not even 5% of the market.
Do you see things? I mean, putting on your crystal ball, how do you see things? It's stable right now. It's at a place historically that's very normal. Do you see things sort of tightening, sort of loosening going forward?
Uh, I don't think we're going to see things loosen going forward. And we've had internal to the company some significant conversations on that front, and also some conversations with the regulator. Today's problem, as you know, is on the supply side, particularly affordable entry level supply. And if demand moves faster, strengthens faster than supply grows, what you get is price appreciation. And so if you ease credit conditions, you only augment that price appreciation. And it's because it's particularly in the low and moderate income space, those would be the most vulnerable households to a cyclical turn. And so I don't think you're going to see easing of credit conditions until there is some more rapid growth in the supply.
Okay, which is what bit us in the what a few years ago. I was going to follow up, and I think I know the answer though. But do you see any of the craziness? Coming back, the stated income, the balloon payments, anything is that dead and buried?
Well, never say
I
never.
know.
Um, no, I never say never because memories do fade.
Yeah.
But in the near term, I don't see that happening in residential mortgage lending, and probably not in the multifamily space either. However, I would say in commercial credits,
Hmm.
there is some evidence of covenant light. That's a term they use for weakened prepayment or claims, not prepayment, but claims on collateral in the contracts. That's outside of the housing space, though.
So that might though sort of presage this potential for maybe overbuilding, too much square footage in the commercial space, possibly.
Well, I think you're seeing some slowdown in some segments of the
Yeah.
commercial space because of that. Because you've heard the chairman of the Fed comment that the non-financial corporate credits is a place that they're watching because the share of it, which is rated um, high risk or triple B, is at all-time highs. And one of the concerns is if there is a credit event that shakes the market and those triple Bs get downgraded, there's a bunch of companies that hold them that would have to liquidate and move up the credit criteria or the credit ladder. And whether there's enough liquidity in the market to support that is questionable.
Okay.
And so that is on the watch list of the Fed.
Let's switch gears a little bit. How can you talk about the correlation between the Fed funds rate, that is the rate at which the big banks, the other financial players lend money to each other, and the 30-year fixed mortgage rate for us normals? They don't necessarily move together, do they?
They do not. The and it is it's really is about the window through which market participants are thinking about changes in valuation of assets or the growth or change in the growth of earnings. So 30 years is the very long term, and you're thinking about returns on an asset over a very long time period. Those returns may vary significantly in the short run, but average out over the long run to a very different profile. As you know, in the mortgage space, the 10-year treasury is really the underpinning of where mortgage rates are going to go, and that's largely because the time that an average household lives in the same house or doesn't refinance the existing mortgage that they have is somewhere in the 7 to 9 year time frame. It varies depending on where rates have been and where they're going, but the tenure is a reasonable approximation for how long people stay in their house,
Okay.
and that's why it becomes the base for pricing in the mortgage space. Right now, we are watching the spread between the 3 month treasury bill and the 10-year treasury,
Yeah.
and it's been inverted for over a
Yeah.
month. And so
Explain
that,
that. 'Cause you saw a spate of articles about that,
yeah,
and there was sort of a lot of hand wringing associated with that. Explain that if you could briefly.
yeah, there's a correlation between that inversion where short rates are higher than long rates and the subsequent emergence of a recession. And I use the word correlation, not causation, because it's not
Yeah.
exactly clear what all the thinking is in a market that leads to that inversion. But if you think about banks taking deposits at the short end and then making loans, it's difficult to make money when longer term rates are lower than short term rates.
Yeah.
So their net interest margins are squeezed. And so that leads to a shrinkage in credit extension by banks, which is one of the engines of economic growth. The second thing is that some market participants are probably thinking that because of the expected unfolding of economic events, the Federal Reserve is going to have to lower rates in the future. And so that is being anticipated in those long rates today. And that suggests an outlook of declining corporate profits, which would suggest less economic activity, and therefore you wouldn't want to be investing out in that space if returns are going to be falling. So it's not really, there's other explanations as well, none of them completely compelling. It's probably a combination of
Yeah.
things. One of the questions that I have talked to some researchers who have spent significant time in this, and I've asked them, does it matter how long it's inverted
Yeah.
or the degree to which it's inverted? And I get kind of fuzzy answers.
Hmm.
My personal sense is the longer it's inverted, the stronger the signal is. The depth of the inversion you have to be a little careful with because it depends on what the base rates are from which it's inverted. So if you go back to the Paul Volcker days when interest rates are at 15%, a 3 percentage point inversion
Oh, yeah.
is probably not as serious as when rates are 2% and it inverts by a 0.5%,
Yeah. Just a
right?
degree
So
of yeah, that makes
yeah,
sense. Yeah.
yeah. So you got to think about that. One other factor that's out there today that I think is a reason for some to be skeptical about whether that correlation will result in a recession is that the 10-year sovereign debt rates across the globe are negative in many
Hmm.
instances. The German 10-year bond is negative by about 20 basis points. So if you're trying to think of where are you going to put your capital in a liquid global market, the US is probably the place to be. And so those inflows into that longer end of the yield curve will hold it down.
Yeah.
So
Is it
that's a factor to
Is it
consider.
fair to say, is it just at its heart, it's sort of it just when that kind of that kind of inversion happens, it indicates to investors that they're a little more attracted to short term gains versus longer term gains. That hurts investment longer term. Is that fair?
Yeah, it is. Um, but you can't put all your eggs in one
Yeah.
basket. So you may shift in one direction or the other,
Okay. Okay.
but can't put everything there.
Let's talk about the FHA. What is the current footprint, if that's the right term, for the FHA on the mortgage market? What kind of capture are we talking about?
Yeah, they're probably about a quarter of the outstanding market today. I don't have the number
Yeah.
right in front
Okay.
of me,
So
but they're significantly bigger than they were, say, in the early 2000s. Their share of current production had gotten as low as 3 or 4%.
wow.
Then in the crisis, they rose to over 20%. One of the things that's holding them with a higher market share is an interesting sociological thing. So you've heard lots about student debt as an inhibitor to people buying homes. Well, many of our people who went in the military didn't undertake student debt. They got training in the
Mm,
military. They come back from the military, and we've had a lot of people in the military over the last decade come back from that experience, and they have no debt, and
yeah.
they have a trade, and they can go to work, and they can buy a house. So
Yeah.
they get a VA loan. There's actually no loan limit on the size of VA loan that you can get.
Yeah. And they can get them at
So
tremendous rates, right? They can
that,
get it at
that's right, very good rates,
and
and you
very little
can.
down, if anything, right?
That's right, and you can also refinance that into
Mm.
another VA loan as you move to another home. So VA has been a driver recently of the FHA share. Obviously, they have long been a major source of credit for first-time homebuyers, since the biggest hurdle to a first-time homebuyer is the down payment. And they have a higher share, an appetite for a higher share of low down payment loans than either the GSEs or the banks or other portfolio holders have. And so they've always been a first time homebuyer engine.
So is that fair to say that is the entry level part of the market that would get hurt the most or is the most vulnerable if the FHA were to pull back its activity?
Yeah, there's no question that a reduction in FHA would reduce the access to credit for the overall first time homebuyer population, because, as I say, they have a credit appetite that goes further than the GSEs do or the banks do. So they're willing to take more risk, and they have statutory requirements about what reserves they have to have um, uh, aligned with that risk. But they
Okay.
clearly
And
are.
how housing is such a conveyor belt that classically you need to have the entry level folks buying homes so that first move up can then move up to a move up, and who in turn they need to sell their home to someone who's going to do so they can do a second move up or executive home. It's just so that's the bedrock, the foundation is that entry level part of the market.
Yeah, and they also are running into the same hurdle as other lenders who would lend in that space, which is simply the lack of supply, because people aren't moving
Yeah,
up today. they're,
yeah,
they're aging in place, or they're
yeah,
tearing the roof off and adding another floor. Or, and I know we've talked about that. The challenge in the builder community, which is traditionally not built to the entry level home buyer, because that is where the first time home buyer buys that home sold by a move up buyer,
yeah.
and then they put some sweat equity into it, do a little repair, they take that equity out, and they become a move up buyer. But that engine isn't operating the same as it was.
Yeah, it's delayed. It's kind of like the whole life stage. People are, the millennials are classically doing things a little later. Well, home buyers are doing things a little later as well, in a sense.
Yeah, and if you look at the residential fixed investment data, there's a very striking chart that I use to describe a structural change that's taken place. There was a long established relationship of the share which was invested into single family home construction, apartment construction, and remodeling. In the crisis, the multifamily apartment construction stayed relatively similar. It slowed a bit, and then it picked up a bit, and it's been relatively flat, but it's roughly stayed in its long term range. But the remodeling and the
Yeah.
single family construction flipped
Hmm.
because, of course, we stopped building new homes. But what is striking is they've come back together and they're basically at the same level. They're the same share, but not that you would have thought they would have diverged with much more money going into the single family construction space. And that has not happened.
Hmm.
That's a really
That is,
very interesting thing.
is it remodeling just sort of maintaining the pace with the single family activity, and or is it?
No, it's an equal share of business of residential fixed investment
Huh.
dollars. The same, and this is the boomers aging in place, and they've got $7 trillion of equity.
Huh.
They are tapping that equity. They're remodeling the home because they want the kids to come home and bring the grandkids.
Yeah.
And and of course they would have been the group that would have been moving either up or down and
Yeah.
freeing up that existing home for the
Yeah.
entry level buyer.
What are they
It's
thinking? They want their kids to
a,
wow.
yeah, yeah. Well, the grandkids you can always send back home. They don't want the kids to come home and stay, that's for sure. But the grandkids you can send home.
Yeah, that's probably the better option.
Feed them all the sugar, send them,
And then send them home. Um,
payback.
there's a lot of discussion about returning Fannie Mae and Freddie Mac to the private market, so sort of privatizing those major GSEs. Is that likely? How likely is it? And follow up, how would that impact mortgage rates?
Well, I have a hard enough time forecasting interest rates. I'm not going to forecast politics, but it's certainly the administration has expressed a strong desire to end conservatorship and move the companies back into the private sector, but in a structural way that leads to competition. And now, what are the probabilities of that happening? I don't know. I would say they're higher than they've been in the past, simply because the administration has stated that it's a priority for them. There's lots of things that have to be done to get that done. If you, for example, if you think about a firm that's capitalized with bank-like capital, you'd have to raise more capital than a full year's U.S. economy initial public offerings
Mm,
to get that done, just for those two institutions.
wow.
And it's a lot more than that.
Wow.
So it can't be done suddenly. It will take some time to get it done if it's going to be done. And, it's been 10 years. So if you're a betting person, you might say, well, if they, why is it taking 10
Yeah.
years? And why do you think it's going to happen in the next two when it hasn't happened in 10
Intent.
years? So, I don't know the answer. So what are the implications? Well, for one thing, I mean, I'm a taxpayer too, and we, the GSEs, are a contingent liability on the public balance sheet in conservatorship. The reason they would like that some policymakers would like to privatize it, they would like private capital taking that risk, not the public. And I'm
Yeah.
sympathetic to that. I think that's positive. The risks of us to the public should be remote. And so one of the things that will likely be done is some sort of an insurance fund put in place such that if there's another event where there are significant losses, that insurance fund stands in front of taxpayers.
And then watch, but there'll be some horrific arm wrestling over who pays for that insurance fund, won't there?
Oh, sure, absolutely. And it almost certainly means that at the margin, interest rates will be higher.
Okay.
Nobody knows exactly how much higher. There have been a couple of articles written recently about just the discussion of privatization having widened spreads. I don't think that's true. It may be at the margin that might be true. Part of what's going on there is what I said earlier about Ginnie Mae tightening criteria on some refinancing churn, which improved the value of Ginnie Mae securities relative to Freddie and Fannie. It's also the case that with interest rates having fallen back, prepayment speeds have risen for mortgage-backed securities, which means the spreads have widened as well. So there's several reasons why spreads would have widened recently, in addition to any potential concern about risk of privatization. So I don't think that was the main driver.
So it's fair to say, though, that if it does indeed happen, it's going to be a fairly long-term process just because of the amount of the money involved, and it'll be foreshadowed and under a controlled process.
That's right, and it could lead to some incremental increase in mortgage rates to consumers,
Okay.
as that risk gets priced properly by private parties.
Let's just switch to a topic that I know is near to your heart. It's this idea of this new single security and what this means.
Mhm.
Specifically, let's what this means for mortgage qualification, mortgage policies. And by the way, Doug, please use really small words when you explain this, like you're talking to an 8-year-old, but not even a particularly bright 8-year-old. Asking for a friend, but single security. What is that? What does it mean for mortgage?
Well, that's how my parents talked to me when I was growing up. So even then, I struggled. But um, in right now, investors have a choice between buying mortgage-backed securities that are issued by Fannie Mae, by Freddie Mac, or by Ginnie Mae. And Ginnie Mae is a wholly owned agency with the full faith and credit of the U.S. government. Fannie Mae and Freddie Mac are in conservatorship, which means they're basically under the administration of their regulator, but with the idea that they will eventually be released back into the private sector, and their securities do not have the full faith and credit of the U.S. government. However, the conservatorship gives the investor the security that, at least today, they essentially have that backing. Now, Fannie and Freddie are essentially two firms with slight differences in the way that they operate in the marketplace, and it has resulted in the differences in their securities has resulted in the securities of Fannie Mae being much more liquid. That is, they're traded more frequently, so the price signals are clearer than Freddie Mac's. So in anticipation of creating a market which is more competitive, the regulator has determined that there should be harmonization between the characteristics of the securities issued by the two organizations, such that the issuance is fungible between Freddie and Fannie. So you can issue a single security backed by loans from both, and that investors won't perceive any difference between whether there are Fannie Mae guaranteed loans or Freddie Mac guaranteed loans in that security.
Would it be the full faith and credit like Ginnie as opposed to Fannie and Freddie?
It will not be at this point full faith and credit. One of the proposals is that in the future, a guarantee or an insurance would be assigned to the security as opposed to the institution.
Yeah.
And this would be a precursor to a move in that direction.
Okay.
The intention is to equalize the liquidity between the two organizations, which should lead to some equalization of competitive position.
Would that in turn lead to more potential mortgage, more money out there? I don't know if looser is the right word, but at least more potential volume in mortgage world?
Conceivably, yes. And it is. It would also lead to some learning by other parties that might want to get into competition about what they would learn about the performance of those securities, may offer them some insights into how securities they might envision issuing would perform were they to get into competition. If the reform process that ultimately makes its way through the Congress and the regulator is structured in such a way that other entities could acquire the same charter and then compete.
Let's end with me putting you on the spot. Let's imagine that Fed Chair Jay Powell, the head of the FHFA, Mark Calabria, who, by the way, oversees GSEs, and you, effectively, the FHA Chair Brian Montgomery, and of course, let's not forget Treasury Secretary Steven Mnuchin, the guy who likes to handle those crisp $100 bills. Let's say they called you into a room and they asked you, what should we do in terms of mortgage policy to change it for the better? What would you suggest to them?
Well, I think that in the U.S. we tend to believe that markets are pretty efficient at allocating credit as long as there is transparency on the risks that are being taken. So I would say whatever they can do to make clear the risks and that those risks are priced by private parties will lead to more efficiently functioning markets. So I didn't note I said efficient, not perfect. A lot of people confuse those two terms. Markets will never be perfect because they're instituted by humans who are not perfect. So that's a first step. And a second step would be to make transparent to consumers all of the risks that they are undertaking, so that they're clearly knowledgeable when they sign a document, that they understand that document and are willing to be held accountable for what they have signed up for. I think there's
How would you though, Doug? How would you protect the consumer? Because let's be honest, that's great in a perfect world, but most folks don't know really. The folks making the mortgages are always going to be at a huge informational advantage over the folks accepting the mortgage. That's just the reality of it. Is there a role there for the consumers to be protected from in this process because they simply aren't going to have the level of understanding of those mortgage policies?
Yeah, it's a difficult. That is a difficult challenge because, in large part, people have to be willing to undertake the education to protect their own interests. I can't tell you the number of times that I've gotten a call from a consumer who hears me talk on some talk show or something and says, "Hey, I'm thinking about buying a house and taking a mortgage. What do you think about this company?" And I would say, well, I said, competition only works for you if you activate it. And that means making companies compete against one another. And I personally have had several mortgages over my life. And in no instance did I ever talk to less than 3 lenders. And in every instance, I got a better deal at the end of the day than the first deal that was offered to me by making them compete. Okay. So to some degree, the consumer has to act in their own interest. Now, we do have laws that about truth in lending and equal opportunity, and there's a series of laws that are intended to prevent mistreatment of consumers, and those should be enforced vigorously because they are in most instances born of known abuses. So there's a role for regulation in this space as well.
Okay. I mean, without those, you lose that idea of, that fully informed competition if you're not truthful in what you're offering.
That's right.
Well, Doug, I really appreciate that. This has been you lived up to being an august guest on our podcast, very much so.
and it's only
and then some. So thank you so much for joining us.
My pleasure. Good being with you. Take care.
Awesome. All right. Thanks a lot, everyone. Hopefully give us a listen next time we're on. Until then, we'll see you next time.